Welcome to the video on inherited 401k accounts, the 10-year tax rule, and how to maximize your windfall. First, we will set the stage by explaining what an inherited 401k is and why immediate action matters. Next, we will preview how the 10-year rule works, common pitfalls, and the strategic approach to turn this windfall into long-term wealth. Finally, we will outline a step-by-step plan and real-world tactics to help you save on taxes and build future financial security. In this agenda, we will cover the immediate steps to take with an inherited 401k, the 10-year rule for non-spouse beneficiaries, how to avoid penalties and high fees, the strategy to spread withdrawals over time, a checklist and examples, and short quizzes to reinforce learning. As we proceed, each section will build on the previous one so you can take confident, informed action. Before we begin, this content is educational and not personalized financial, legal, or tax advice. Laws and regulations can change and may vary by jurisdiction. Please consult a fiduciary financial advisor or a qualified CPA who understands your specific circumstances before taking action. Now, with that important context, let's move into the critical first steps. The first and most urgent move is to execute a direct rollover from the inherited 401k into an inherited or beneficiary IRA. Start by selecting a reputable, low-fee custodian such as Fidelity, Vanguard, or Schwab. Then open an account specifically titled as an inherited or beneficiary IRA in your name, referencing the decedent. Next, request a direct trustee-to-trustee rollover so the money never passes through your hands. Do not accept a check made payable to you, as that could trigger withholding and potential taxes. Finally, avoid leaving funds at the original institution because administrative fees are often higher and can erode your inheritance. With the account properly set up, you have more control and lower costs. For non-spouse beneficiaries, federal law requires that the full balance of the inherited IRA be withdrawn within 10 years of the original owner's death. These distributions are taxed as ordinary income in the year you take them. You cannot roll this inherited money into your own retirement accounts. Moreover, if the decedent had already started required minimum distributions, you must continue those annual distributions in addition to satisfying the 10-year full withdrawal rule. Therefore, a thoughtful schedule of withdrawals is critical to managing taxes effectively over the decade. Begin by gathering plan statements, the date of death, and your beneficiary documentation. Next, open a properly titled Beneficiary IRA with a low-fee custodian. Verify that the account is titled as your name as beneficiary of the decedent's name. Then contact the 401k plan to request a direct trustee-to-trustee rollover into the Beneficiary IRA. Confirm that there is no withholding and that no check is mailed to you personally. After the transfer completes, save confirmations and statements for your records. This ensures clean documentation for tax and compliance purposes. This timeline illustrates the 10-year window. Year 0 marks the setup of the Beneficiary IRA and the start of the clock. Years 1 through 9 show planned withdrawals, designed to coordinate with your expected income and tax bracket in each year. If the decedent had already started required minimum distributions, the timeline reminds you to take those annually as well. Finally, in year 10, any remaining balance must be fully withdrawn to comply with the rule. The timeline emphasizes annual reassessment alongside tax planning and employer benefit elections. Taking a lump sum in a single year can push your income into much higher tax brackets, raising your total tax bill. By spreading withdrawals over the 10-year period, you can better manage your marginal tax rates. Additionally, coordinate the timing of distributions with other income events, such as bonuses or restricted stock vesting, to avoid stacking high income in the same year. This approach can reduce taxes and preserve more of your inheritance. Comparing the old employer plan to a low-fee custodian reveals key differences. Old plans often carry higher administrative fees, limited investment menus, and more cumbersome beneficiary processes. In contrast, low-fee custodians tend to offer lower costs, broader diversification options, and more efficient paperwork, along with robust planning tools and automation. Therefore, moving to a reputable custodian typically improves both cost and convenience while enhancing your ability to execute a tax-smart strategy. A powerful strategy is to let inherited withdrawals cover your current living expenses, while you redirect more of your regular paycheck into tax-advantaged accounts. First, aim to maximize your employer 401k, at least up to the full match. Next, prioritize contributing to a Roth IRA if you are eligible, because long-term tax-free growth can be extremely valuable. Throughout this process, calibrate the size and timing of inherited withdrawals so you stay within target tax brackets. Revisit your plan each year as your income and the markets change. This simple snapshot compares common features. Many old employer plans carry higher administrative fees with limited investment choices and basic tools. In contrast, low-fee custodians like Fidelity, Vanguard, or Schwab typically offer comparatively lower costs, broad and diversified fund menus, and robust planning tools and automation. Actual fees and features vary, so verify details with each provider. Quiz time. The question is, within how many years must a non-spouse beneficiary fully withdraw an inherited IRA? The options are 1. 5 years, 2. 10 years, 3. By age 59.5, and 4. There is no deadline. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 10 years. Under current federal law, most non-spouse beneficiaries must fully withdraw the inherited balance by the end of the 10th year following the original owner's death. Here is the second quiz. If the original owner had already started required minimum distributions at death, what must you do? The options are 1. Nothing changes and you ignore RMDs. 2. Roll it into your own IRA and skip RMDs. 3. Continue annual RMDs and still empty the account within 10 years. Or 4. Take a single lump sum immediately. You may pause the video now to consider your answer. We will discuss the answer in the next section. The correct answer is to continue annual required minimum distributions, and also ensure the account is fully emptied within 10 years. Both requirements apply when the decedent had already begun RMDs. Here is a practical checklist. Open a beneficiary or inherited IRA with a low-fee custodian. Request a direct trustee-to-trustee rollover. Verify the account titling and ensure no check is issued to you. Create a 10-year withdrawal plan aligned with your expected incomes. Use inherited withdrawals to cover living expenses so you can maximize your own 401k and Roth IRA contributions. Finally, reassess annually with a qualified professional to adjust to changes in income, tax laws, or markets. This flowchart shows the cash flow engine. Inherited IRA distributions flow to pay current living expenses. Meanwhile, your paycheck is redirected to maximize contributions to your employer 401k, capturing tax-deferred growth, and to your Roth IRA, building tax-free growth, if eligible. An annual review node emphasizes adjusting distribution amounts to manage your tax brackets effectively each year. These key takeaways summarize the plan. Execute a direct rollover into a properly titled Beneficiary IRA, and avoid receiving a check personally. Use a low-fee custodian to reduce costs. Plan to spread withdrawals across the 10-year window to manage taxes. If required minimum distributions had begun, continue them annually. Finally, use the inherited funds to cover current expenses, enabling your paycheck to build long-term, tax-advantaged growth. In summary, act promptly to open a beneficiary IRA and request a direct rollover. Stay vigilant about the 10-year deadline and any ongoing required minimum distributions. Avoid lump sum withdrawals that can spike your tax bracket, and instead smooth income with a planned schedule. Use the funding flip to maximize your 401k and Roth IRA. Finally, review the plan annually with a qualified professional to remain optimized as your situation evolves. Thanks for watching. If this helped, please like the video, share it with someone handling an inheritance, and subscribe for more practical, step-by-step money strategies. In the comments, tell us your biggest question about inherited accounts, or how you're planning your 10-year withdrawal schedule. See you in the next one.